Welcome to Iron Financial. This is the show where we forge stronger portfolios by cutting through all the market weakness and all the noise. And today, man, we are putting Beta Technologies directly under the microscope. Their latest earnings report just hit the street, and honestly, it is a complete battleground of contradictions. You've got record-smashing growth on one side, clashing head-on with absolutely catastrophic losses on the other. So the big question, the one we're going to tackle today, is this. Is Beta building an impenetrable, long-term fortress for the future of aviation, or is this entire operation a house of cards, just waiting for a gust of wind to come and knock it all down? We are going to dig deep into the numbers, we're going to stress test the very foundation of this company, and we're going to find out where the real strength lies. Let's get into it. All right, let's start with the bull case, because you have to start here. On one side of the ledger, you have a revenue story that is frankly on fire. I mean, we are talking about a massive beat on that top-line number. Revenue didn't just grow, it skyrocketed. 150.7% year over year. Think about that. That's not just growth. That is explosive, undeniable demand. It's a signal, loud and clear, that the market wants what Beta is selling, and Beta is delivering. This is the kind of number that tells you there's a powerful engine here, and it is forging ahead at full throttle. You just can't ignore that kind of momentum on the top line. It is the absolute bedrock of any growth story, and it's tangible proof that their concept is working in a market that's just full of empty promises. Whoa, hold on a second. Okay, a beat of over $3 million. I'll give you that. That's impressive on the surface. But let me ask you this. If the engine is so powerful, why is the stock down 4% after they announced the supposedly great news? The market, the so-called smart money, is looking right past that shiny revenue number. They see something else. Something is making them really nervous here. So if the sales story is so fantastic, what is spooking investors? Because you look at the chart, you look at the share price, and it tells me people are running for the exits, they are not lining up to buy more. That big revenue number, it's clearly not telling the whole story. Not even close. This is what they're seeing. This is what matters. A colossal, catastrophic miss on earnings per share. I mean, look at this. The analysts, the experts, they expected Beta to lose about 49 cents a share. Instead, they hemorrhaged cash, losing over $2 per share. That is a miss of $1.53. That's not some little crack in the armor, my friend. That is a gaping, catastrophic hole in the hull of the ship. It's taking on water fast. You cannot build a fortress on a foundation that is bleeding cash like this. There's an old saying on the street, revenue is vanity, profit is sanity. And right now, Beta's sanity looks completely unhinged. This one number screams to the world that the company has absolutely no control over its spending, and the market is punishing them for it as it should. And that right there is the core conflict. That's the tug of war we're going to break down today. We absolutely have to get to the bottom of this. So here's our roadmap. Here's our plan of attack for today's deep dive. First up, we're going to unpack the market's reaction. Why did the stock fall on good news? Second, we're going to build out the full bull case, looking at all the structural supports that Beta claims it's putting in place. Third, we'll do the opposite. We're going to hammer on that bear case and really search for the cracks in that foundation. Fourth, and this might be the most important part, we're going to follow the smart money. We're going to see what the biggest, most sophisticated players on Wall Street are actually doing with their cash. And finally, we'll put it all together, weigh all the evidence, and deliver our final verdict. So let's get right into the raw data. Section 1, revenue soars, stock dives. At first glance, the market's reaction just seems completely irrational. You see a headline number showing this incredible, explosive growth, but the price action is totally negative. This disconnect, this is where opportunity and risk live right next to each other. And our job here at Iron Financial is to figure out which one is the dominant force here. Are investors just overreacting to some short-term losses, missing the big picture? Or are they correctly identifying a fatal structural flaw in the business model that no amount of top-line growth can ever fix? Let's find out. Okay, let's just lay the raw numbers out on the table so we can all see them clearly. The story here is just incredibly stark. On the one hand, revenue hits $11.13 million. Again, up over 150% from the year before. That's a beat of more than $3 million against what everyone was expecting. That right there is the entire bull argument in a nutshell. They're selling real products to a rapidly growing customer base. But then you look at the other side of the coin. A GAAP EPS of negative $2.02, a miss of $1.53. It's just brutal. And what was the market's immediate verdict? A 4% haircut on the stock price. This slide is a perfect illustration of the tug-of-war that's happening in real time between a really compelling growth story and a frankly terrifying bottom line. And this right here is the real kicker. This is what should worry the bulls. It's not just about Beta's numbers in a vacuum. It's about how they stack up against the competition. As this quote from Barron's points out so clearly, the market is looking at Beta, and it's looking at its direct competitors, companies like Joby and Archer, and it's giving Beta the cold shoulder. It's saying no thank you. This suggests that even within this super high-risk, high-reward sector of electric aviation, investors perceive something fundamentally weaker, or maybe just more dangerous, about Beta's specific position. So this isn't just one bad quarter we're talking about. It's a genuine crisis of confidence relative to their peers. And it just begs the question, what does the market see that the bulls are missing?
All right, let's move on to section 2 and really see how this bull case is constructed. We're going to build it from the ground up. Now, this isn't about hype. It's not about storytelling. It's about identifying the real steel beams and the concrete pillars that could, theoretically, support this company for decades to come. You see, the bears are all laser focused on the quarterly cash burn, and we'll get to that. But the bulls, they're looking at the foundational work being done right now, all the heavy lifting that's required to build a truly generational company in a brand new revolutionary industry. Let's examine the actual evidence for that long-term strength.
Okay, so this is the crucial part. The bull case for Beta really rests on 4 incredibly solid pillars. You have to understand these if you're going to believe in the company. First, a massive and still growing commercial backlog that represents future locked-in revenue. Second, tangible, verifiable progress on what is the single most important hurdle in this entire industry, getting that FAA certification. Third, they're building out a physical infrastructure network, a charging network that creates a powerful moat around their business. And fourth, strategic partnerships with some of the biggest and most respected industrial and defense names on the entire planet. These are not hopes, they're not dreams, these are facts on the ground.
Now, let's just take a moment to really talk about the sheer scale of the demand here. I mean, the numbers on this slide are staggering. We are looking at a total backlog of nearly 900 aircraft. And even if we're being super conservative and we only look at the firm orders, the ones that are locked in with contracts, that's still 289 planes already spoken for. The total value of this whole backlog is an estimated $3.5 billion. $3.5 billion. That isn't a projection from some analyst. It's not a guess. It's a purchase order pipeline. This provides incredible visibility into future revenue streams, and it validates that Beta's technology has serious commercial traction. This is the market screaming, if you build it, we will come, and by the way, we've already signed the check.
And the thing is, they are executing. This isn't just some PowerPoint presentation. It's not vaporware. They are hitting critical, tangible milestones. Look here. The H500A engine, that's their core technology, it is on track for FAA certification in the first half of next year. That right there is a massive de-risking event that unlocks everything else. They've flown over 100,000 nautical miles. That proves the technology's endurance and reliability. They are building out a proprietary charging network, which is a brilliant strategic move to lock in customers and create a recurring revenue stream like a razor and blades model. And just look at the partnerships. A potential billion-dollar deal with Eve Air Mobility, project funding from the U.S. Army. These are serious votes of confidence from very serious players who have done their homework. So the CEO, Kyle Clark, he comes out and calls 2025 a defining year. And you know what? From a purely operational standpoint, he's absolutely right. They went public, they pushed their technology forward, they signed massive deals. He's framing all of this as the successful completion of a foundational phase, basically laying the groundwork for a massive enterprise. But that just brings us right back to the central nagging question. All this progress, all this spending, when does it actually translate into profit? I mean, is this a foundation for a skyscraper, or is it the world's most expensive hole in the ground? Because let me tell you, foundations don't pay the bills. All right, let's flip the coin. Section 3, the bear case. We've seen the impressive facade. We've seen the blueprints. Now we're going to take a sledgehammer to it and see what's really underneath. It's time to stress test this structure and look for the cracks. The bulls see progress, sure, but the bears see a company that is burning through cash at a terrifying and, more importantly, an accelerating rate. So forget the backlog for just a minute. Let's talk about the burn, because that is the fire that could bring this entire structure crumbling down. This chart right here, this illustrates the absolute core of the bear case perfectly. It's simple, but it's devastating. We're looking at the company's full-year net loss. In 2024, they lost $275 million. That's a huge number, right? But look at 2025. That loss didn't just grow a little bit. It ballooned to nearly $746 million. It more than doubled in a single year. This isn't the controlled strategic cost of growth that bulls want you to believe it is. This is a financial hemorrhage. At this rate of acceleration, the company is on a collision course with insolvency unless something drastically, fundamentally changes. This is the kind of trend that gives CFOs nightmares.
And if you thought the yearly picture was bad, drilling down into the most recent quarter only makes the picture uglier. In the fourth quarter of last year, the net loss was $76 million. This year, it doubled to $150 million. And adjusted EBITDA, a measure that's supposed to give you a rosier view of operational profitability by stripping out some of the bad stuff, even that went from negative $68 million to negative $103 million. Every single key metric of profitability is moving aggressively, terrifyingly in the wrong direction. The company's becoming less efficient and it's burning cash faster as it grows. That, my friends, is the literal definition of an unsustainable business model.
And look, don't just take my word for it. This isn't just me, the skeptic, trying to find fault. This is how the market itself is digesting the company's own forecast for the coming year. Bleak. That's the word Nasdaq.com used to describe it. And when you see the company's own guidance, you'll understand exactly why. This isn't some external analyst being pessimistic. This is the company itself telling you straight up that the pain is far from over. In fact, it's going to get worse before it gets better, assuming it ever gets better. I want you to let this number sink in for a second. For the full year 2026, even as their revenues are projected to grow to around $40 million, the company is guiding for an adjusted EBITDA loss of between $305 and nearly $400 million. They are telling you directly that they expect to burn through almost $10 for every single dollar of revenue they bring in. I have to ask, how is that a viable business? At what point does the music stop playing? That $3.5 billion backlog is years away from being fully realized, but this cash burn, this is happening right now every single day. This is a house of cards, and the wind is definitely picking up.
Okay, that is a powerful, powerful bear case. That cash burn is undeniable, and frankly, it's frightening. But now let's move on to what I think might be the single most important section of this entire analysis. Section 4, following the smart money. Because when a company is this polarized, when the bull case and the bear case are this extreme, you have to stop and ask yourself one simple question. What are the people with the most information and the most capital actually doing? Are they running away from this fire, or are they running towards it carrying buckets of cash? The answer, well, it might surprise you.
Okay, let's start with the insiders. We're talking about the executives, the directors, the people who live and breathe this company every single day. They know where every skeleton is buried. They know every secret. In the last 6 months, there have been 7 open market trades by these insiders, and 100% of them have been purchases. 0 sales, not a single share sold. The CFO, the CTO, various directors, they are all reaching into their own pockets, using their own money to buy more shares at these current prices. That is the single strongest signal of internal confidence you can possibly get. They see the losses, they see the burn rate, and they're still buying. They clearly believe the market is mispricing the risk here, and they're putting their money where their mouth is. But it's not just the insiders, which would be compelling enough. The truly mind-boggling evidence comes from this list of names. I mean, look at this. These are the world's most sophisticated investors. In the last quarter alone, Fidelity came in and established a new position worth nearly $1 billion. General Electric, an aerospace giant that understands this industry better than almost anyone, bought in for $645 million. You've got TPG, Amazon, Vanguard, BlackRock. These are not speculators. These aren't day traders. These are institutions with armies of PhD analysts who have torn this company's financials apart piece by piece. They see the same cash burn we do, and yet they are deploying billions with a B to buy in. So the crucial question is, why? They aren't looking at next quarter's EPS. They're looking at 10, 20 years down the road. They likely see this cash burn not as a sign of weakness, but as the price of admission to dominate a multi-trillion-dollar industry. They're funding the construction of the moat, the technology, the certification, the charging network that could create a near monopoly. They are willing to absorb these brutal losses now because they believe the prize on the other side is total market dominance. So are we really supposed to believe that all of them, Fidelity, GE, Amazon, and the company's own top executives, are all wrong? It's a very powerful counterargument to the bear case. And that brings us to our final section, the final verdict. We've laid out all the evidence, the good, the bad, and the ugly. On one hand, you have explosive growth, a concrete multi-billion-dollar backlog, and literally the smartest money in the world placing massive bets on the company's future success. On the other hand, you have accelerating losses and a cash burn rate that looks like a death spiral. So how in the world do we square this circle? Is Beta Technologies a fortress under construction, or is it a house of cards just about to be blown over? Here it is, side by side, the whole story in one slide. The fortress is built on explosive revenue growth, that massive $3.5 billion backlog, and undeniable insider and institutional conviction. These are the strategic pillars. The cracks, though, they're just as real. They are the accelerating net losses, the massive cash burn, and the company's own bleak outlook on profitability. That's the tactical reality on the ground. The bulls argue these losses are the necessary, calculated cost of building a deep moat in a winner-take-all industry. This is the heavy investment required to achieve liftoff. But the risk is so real. The bears see a house of cards fueled by a fire hose of investor cash. If that cash runs out before they finally reach profitability, the whole structure just comes crashing down. It's an incredibly high-stakes bet on perfect execution.
And this number is the key to that entire bet. $1.71 billion. That is the amount of cash and cash equivalents that Beta has sitting on its balance sheet as of the end of the year. This isn't just a cushion, it's a war chest. It's the fuel in the tank. With their current burn rate, this gives them a significant runway. We're talking at least 2 to 3 years to execute their plan, to get their engines certified, and to start turning that massive backlog into actual profitable revenue. This is the capital that allows them to weather this storm and finish building their fortress, while some of their competitors might be out there struggling for funding.
Which leaves us right here with the final provocative question that every investor has to ask themselves. Is that $1.7 billion cash pile a war chest that will fuel their path to dominance in the future of electric aviation? Or is it simply a funeral pyre, a massive pile of cash that they are going to burn through before inevitably collapsing under the immense weight of their own spending? The smart money has clearly placed its bet on the fortress, but as we all know, even the smartest money in the world can be spectacularly wrong. Now you have the evidence to decide for yourself.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.